For the last 2 years, the global economy has been stuck in a state of expectation. Investors, businesses, and households have operated on one assumption: that the Federal Reserve would eventually lower interest rates to provide relief. That expectation met a hard reality over the weekend of July 11th. The United States launched renewed military strikes near the Strait of Hormuz, a narrow passage that carries a significant portion of the world's energy supply. The conflict escalated immediately. Iran launched retaliatory strikes against U.S. allies, hitting targets in Kuwait, Jordan, and Qatar. Global energy markets reacted with a sharp price surge, reflecting the sudden threat to tanker traffic through the region. This flare-up didn't happen in isolation. It landed just as the market prepared for the most critical economic data week of the summer, immediately shifting the focus from growth to geopolitics. Wall Street opened Monday morning with a defensive rotation. This wasn't a broad market crash, but a deliberate move away from risk as traders tried to assess the damage. The Nasdaq led the decline, dropping approximately 1%, while the S&P 500 saw a more modest slip of about 0.4%. The Dow Jones Industrial Average held up significantly better than its tech-heavy peers. Investors pulled money out of AI and technology sectors, moving it into defensive positions like consumer staples and utilities. The Monday session demonstrated that geopolitical instability had overtaken corporate earnings as the primary driver of market sentiment. The pressure intensifies on Tuesday, July 14th. A massive wave of corporate data arrives as JPMorgan, Bank of America, Wells Fargo, Goldman Sachs, and Citigroup all release their quarterly earnings. These reports are the first clear look at how high interest rates are actually affecting consumer spending and the health of the credit market. At the exact same time those bank numbers hit, the Bureau of Labor Statistics will release the June inflation report at 8:30 a.m. Eastern. This chart shows what the market expects to see, not the actual results. The consensus forecast is for headline inflation to ease toward 3.9%, primarily because gasoline prices dropped roughly 10% during June. However, core CPI, which excludes those fluctuating energy costs, is expected to stay flat at 2.9%. This suggests that while energy got cheaper in June, the price of services and other goods remains sticky. This creates a high-stakes scenario. A higher-than-expected inflation reading would give the Federal Reserve a reason to keep rates high, while a soft reading might suggest the economy is finally cooling enough for a cut. The current tension stems from a conflict in data. For 2 years, the math for a rate cut required falling energy prices to lead headline inflation lower. But a new oil shock threatens to reverse that progress, making it difficult for the Fed to justify lowering rates. New Federal Reserve Chair Kevin Warsh will address these concerns during his first semi-annual testimony to Congress this week. The market is looking for clues on how he intends to balance this new energy shock against the ongoing inflation fight. Market participants have already shifted their bets. There is now a roughly 65% probability that the Fed will hold interest rates at their current level during the late July meeting. More strikingly, futures markets are now pricing in quarter-point rate hikes for September 2026 and January 2027. The recent military escalation near the Strait of Hormuz makes these projected hikes appear more realistic to traders who worry about a second wave of energy-driven inflation. The long-standing framework of waiting for central banks to ease their policy has been replaced by a focus on how much higher rates might need to go. These domestic pressures are mirrored globally. On Wednesday, the Bank of Canada is widely expected to keep its overnight rate at 2.25% as it monitors the same geopolitical risks. The Canadian loonie has been under pressure, trading around 71 US cents, as investors weigh the strength of the US dollar against global economic uncertainty. The cryptocurrency market has also responded to the tension. Bitcoin is trading in the low to mid 60,000s, reflecting the same retreat from risk that pressured the Nasdaq. However, there is a technical sign of stabilization. This chart tracks flows into Bitcoin and Ether ETFs, which just ended an 8-week streak of outflows. This reversal suggests that some institutional demand is returning, even amid the broader market volatility. These movements across different asset classes show that no sector is currently isolated from the shift in the global macroeconomic outlook. Middle East conflict, persistent inflation data, and high-impact earnings reports are all arriving in a single window of time. This combination has shifted the perspective of the financial system from a search for interest rate relief to a focus on risk management. Market participants are now focused on the possibility of further interest rate hikes, a scenario that seemed unlikely only a few weeks ago. The events of the weekend have changed the context for the upcoming inflation numbers, making athlete data point more significant for the Federal Reserve's next move. The convergence of oil, inflation, and geopolitics provides the framework that will define the market's direction as we move through the summer of 2026.